Okay, folks, so lots to be excited about and lots to discuss. Number one, we have to talk about an update on the market and plays, including some big runners as well as Ooga Booga AMC. And then for the main entree, I want to give a rundown on one stock that I see as having a lot of upside potential. You already know that I love looking at stocks right before they have big catalysts, and this time is no different. And before we get into all of this, the only thing that I ask of you in return is that you hit that ravishing like button, and also don't forget to subscribe either. In terms of the market, you had a strong pre-market that then tanked, tried to come back a bit, not much change overall. Quite frankly, the market technicals suggest that we're in for more bearish trending. And with Fed talks tomorrow, we should see some more volatility. My take is that for folks who are looking for dip buys on long-term positions, keep some capital on the sidelines. And for short-term positions, it's still fair game, but you want to be extra cautious with exit points because you have an overall market that's becoming a lot more volatile and usually to the downside. Moving on to plays. So RWLK, this had a huge pump and dump in the after hours and pre-market, and when I saw it in the pre-market, it was dumping faster than trash down a chute. However, having considered that it had already managed to bring in 2 rounds of buying pressure after sell-offs during the extended hours, I gave it a solid chance of both rebounding after open and bouncing back to extended hours highs. And it did end up hitting that projected best case scenario guideline within an hour and a half of open, and then went on to hit new highs in the 250s. Now when it comes to dealing with probabilities, you can identify a stock that has a solid chance of running. You can control your risk on said stock by forcing it, for example, to break into an upward direction above our red directional SMA line. In this case, I thought that we had a 20% chance of achieving our best case scenario, but even if we didn't, at least forcing it to have an upward direction would allow you to avoid it if it just tanked it open, or control your risk if it didn't run as much. Okay, moving on. The Atter short squeeze play has continued picking up steam as it attempts a round 2. The short numbers are pretty fun though. What I like to see is short sellers feeling like they made headway during a sell-off, only to be met with higher borrow fees during the rebound. This generally happens when shorts get faked out. They see a stock going down massively, so they increase their short position. But if all of a sudden it doesn't consider dropping, then what happens? Well, they got faked out and it starts going up and they start getting more and more red. But now because they used a lot of their available ammo, there's not as many shorts available. The risk profile has gone up and borrow costs are skyrocketing. And that's what happened here with Atter. Borrow costs are reaching all-time highs at the same time where Atter's price hasn't made much headwind yet. And the short interest itself still has room to grow to break out to new levels. Basically, this means that short sellers are in a worse situation now if this continues going up than they were a week ago when this was going up. They have more ammo in this, they've over-leveraged themselves, and they were overconfident in the downtrend. We'll see if it manages to get more buyers. BBIG has continued its bountiful tanking. I continue to believe that the biggest issue with the stock is that, quite frankly, the main catalyst for it is a ways away. We're talking main catalyst October 15th. And it seems inevitable that as we go into October, you do eventually see this declaring a consistent level of support from which it could have new hype cycles from. But the question is, where is that support going to come in? Okay, next, CRVS. So on Friday morning, we briefed on CRVS because they had an FDA approval for their lymphoma treatment. It ended up going from 4 to 7.1, and on Sunday's video I projected at best you'd get another day of running before a sell-off. Usually FDA catalysts are big, strong, and then they die off like an hour later. Sometimes they last a couple of days. But surprisingly, this one has stuck around yet another day, going as high as 954 and performing pretty well yesterday despite the massive risk-off trading. My thought process is enjoy the run while it's here, but this is a catalyst play and this run isn't going to last. I'd be shocked if by Friday it doesn't have a massive downtrend. Okay, moving on, the Scape of Quantum announced some good news today. This morning in a filing, they said they had signed an agreement with a top 10 automotive manufacturer by revenue. I said I will be watching to see how well it can hold upward direction. It has held its upward direction, but hasn't really moved much post-original reaction thus far. But this is a big sneaking deal for the company. This is, again, the second major manufacturer that they've partnered with, and a huge proof of concept for their battery technology. If you forgot, the first one is Volkswagen, which is one of the biggest. Quite simply, this is a company that many people were riling up the share price in late 2020, specifically because they thought this would be the biggest EV battery supplier ever. Right now, we're getting away from speculation and we're getting into actual hard data that companies do like their battery technology and they are showing demand for them. I'm not making an argument for it to run back to where it was before, but now that it's sold off like 80+%, it's hard to argue that a slew of positive partnerships and obvious demand isn't going to be beneficial for the stock. Next, Ooga Booga AMC. AMC has flown towards breaking back back both below 50 and now below 40. One of the best cards the market can hand to short sellers is an overall market-wide risk-off sell-off. When the market as a whole sells off, institutional players who have been longing AMC then start pulling back on all of their positions, which of course negatively impacts stocks like AMC, creating predictable selling pressure, which is then accelerated by the short sellers. And of course, it also takes out a lot of those momentum traders that were buying it, hoping for a new momentum rally. And of course, sell-offs in lower and lower channels do cause the risk profiles of short sellers to become healthier and decrease the chance of imminent margin calls. So essentially, if AMC decides to find consistent support at 30 or 25 instead of 40 or 50, well, that gives short sellers a lot more room to defer and defer and defer and leaves them with a much better risk profile. The more red a short position is, the more dangerous the risk profile and the harder it is to hold. But as always, the story of AMC is the battleground between longs and shorts. And I don't know if you agree with this, but it doesn't seem like the Ooga Boogas are going anywhere. Lucid, okay, well, it's nice to see that we as a retail community are largely getting recognition on this play. More than ever, it's nice to see Lucid running up on something fundamentally based. This run, the strength that we've seen, is based largely around their battery capacity. But they also reportedly registered around 10,000 vehicle identification numbers, suggesting real progress on eventually rolling them off the lots. There's also going to be a lot more opportunity for press coverage, which has been very, very favorable to Lucid so far. Next week on the 27th, when Lucid opens up their doors, their factory doors to analysts. They'll also be letting analysts drive the air. Biggest threat to the run? Well, a share offering. I would hate that, but it wouldn't be out of Lucid's character. We've seen them change some of the numbers before in ways that weren't great for current holders. Need I remind you of the changing of the terms on the CCIV merger? Upstart. Okay, what the honest hell? I'm not usually accused of being someone who's underly bullish on growth companies. Like, no one's going around, Charlie isn't bullish enough on the growth sector. But with this one, boy, has this exceeded my expectations. Quite frankly, this is an awesome company, and I made a huge argument for it over and over again when it was trading at like a third of the valuation. Quite simply, the ability of their technology to use 1,000+ variables to reach new credit markets is insane and is an ingenious idea, and is certainly making them extremely competitive. That being said, at this point, these valuations are making me so dizzy. I love the company. I love their technology. I think they're going to do very well, but I feel like at this point, this stock is really being driven by more of a meme rally sort of situation where a lot of people are buying it as momentum traders, then accelerating this bullish cycle. Probably going to end badly for people who are buying right now, but I'd be more than happy to buy the dip when it inevitably goes back down. Okay, so the stock of the hour, the main entree. SoFi. SoFi is trading well down from all-time highs. It was at 28 at the start of February when SPACs were hot, then sold off huge bounce back in June to 25, and now once again it's hovering in the 14s. Now what actually is SoFi? Is it the Fi of the So? Because that sounds weird. Well, it is, but it's more than that. It's a personal finance company that basically can be described as getting their little hands in every little niche. Anything that's profitable, SoFi is trying to attack. And where do they make most of their money? Well, with lending. People used to call that loan sharking, but that's not PC anymore, I guess, so it's just called lending. But boy, were those the glory days. Things aren't fun anymore. Back in the day, you don't make a payment, some guy named Tony comes and breaks your leg and threatens your family. These days, companies just give you late fees and maybe you get a little ding to your credit. Boo-hoo. But anyways, what is interesting about SoFi is not only does it have a solid backbone in lending, but SoFi has very quickly been growing out their financial services sector and shows the most potential there. With financial services revenue nearly 3xing between Q1 and Q2 of this year. You look at lending versus financial services, for example, lending is healthy, it has a healthy growth rate, and it's the backbone of this business. But financial services is just taking off in terms of growth rate. It's also true that SoFi has some more diversification outside of that as well, with a sizable chunk of revenue coming from their technology platform, Galileo. So SoFi, while it is indeed a growth company, it's not like YOLOing everything on the financial services sector. It has a backbone in lending and technology, and the technology is actually being used by other competitor fintech companies, which diversifies away SoFi's inherent risk to their core business model as well. Now, problems, who ain't got problems, right? Quite frankly, everybody and their mother is trying to compete in the fintech industry right now. Companies are seeing how damn profitable it is, and they're all like, I want some of that dough, baby! So SoFi has a ton of competition, but to be fair, SoFi has the member growth trajectory that suggests it'll be able to maintain a stronghold on the market. Each member that joins for any part of SoFi's business is a potential customer, or at least a strong lead for all of SoFi's other services and products. Truth be told, we've seen this in a lot of companies. Once a member is in the ecosystem, it becomes very, very easy to market to them. So seeing this trend of more and more membership is very, very good in terms of showing proof of concept for the future. In terms of other risks, well, a part of the lending revenue comes from student loans, and the student loan payment situation has been paused through January 2022. And that could be delayed even further, right? But you look bigger picture, you look past a couple quarters, and you can easily make the case both fundamentally for this being undervalued, but also technically sitting fairly close to long-term support. But here's where it gets good, where the catalyst comes in. I would argue that a lot of SoFi's trading and relative stagnation right now is based on the fact that their acquisition of Golden Pacific Bancorp, a local bank, has been pending regulators' approval since like March. People are waiting to see if this gets approved, because if it does, then SoFi becomes an actual bank instead of a company that hooks you up with banking providers. Without being a bank itself, SoFi has to contract with banks. Contracting with other parties limits the amount of freedom that they have in terms of setting interest rates, controlling the competitiveness of their products, and overall reduces the freedom they have in terms of their expenses. It will allow SoFi to essentially operate as a bank, which will open a whirlwind of opportunities for them. Why are they trying to acquire a small local bank instead of just going straight to regulators and ask for a bank charter the old-fashioned way? Well, because that's a lot more difficult and takes a lot more time. Instead, you just go and buy a bank and you're good and golden. Unfortunately, though, even that takes some time, because regulators have to approve that acquisition, because they know that if they approve the acquisition, that means that a banking charter will extend to all of SoFi's operations, or at least the structure at which they need the bank charter. Best case scenario with SoFi, they get the acquisition and they win the banking charter in the easy route. Worst case scenario, they don't get the acquisition, and then they have to go the traditional route, which every other bank has gone through. So at the end of the day, both outcomes are the same. You get the banking charter. Put that together with SoFi being very, very low, and all of the competitive features that it has even without the banking charter, and all of a sudden you're looking at a play that I believe has a lot of upside. So anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below, or join us on ZipTrader Circle if you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course our daily morning briefings, where we brief on all the latest catalysts each and every market open morning. Well, I'll go ahead and put a link to ZipTrader. You go ahead and watch the video on the ZipTraderU.com website and see if it's a good fit for you. Coupon code FUDSTOPPER50 will get you $50 off before checkout. And if you're wondering what broker to trade these stocks on, well, we like to always send new traders over to Webull, and they will give you 2 free stocks when you sign up and deposit just $5 using our link below. Anyways, have a good one, and I'll see you in the next video.